Hey everyone, welcome into this weekend special here on ResourceSpots.com and the KE Report. My name is Corey Fleck, and today I'm fortunate to be joined by Lawrence Roulston, lead editor and founder of Resource Opportunities. You can find his website at resourceopportunities.com. Lawrence recently just put out an editorial on our website as well as his. Go check it out. Follow the links to his website. It's a nice recap of where he found 2012 going. Interesting comment I found out of that was he finds it's the worst market that you have seen in the last 30 years. Unfortunately, not a good sign for us, but there is some good potential investments coming up in the future. I work closely with Lawrence. He's one of the smartest geological minds as well as business structure of a mining company. So whenever I have geological questions, I go to Lawrence. So I'm very happy to have him on the show. Lawrence, thanks so much for joining us.
Oh, it's always interesting talking with you, Corey.
All right, Lawrence, now just leveraging off of this article, you want to give us a nice little rundown of what you touched on and kind of where you see this market going in 2013?
Well, Corey, as you noted, it was a terrible, terrible year last year, and across the resource space, majors, juniors, and everything in between pretty much got clobbered in their share prices. And it's interesting, in spite of the metal prices being strong or even up during that period, the equities are performing terribly. Now, a couple of reasons for that. First of all, investors around the world have fled risk. Looking at the situation in the United States and Europe, even talk of China slowing down, the Japanese situation not looking good. Not surprising that investors have fled any aspect of risk, and the junior resource companies at the top of the list in terms of being risky. But another element that's very, very important and unique to this sector, in 2010, 2011, there was about $20 billion of new money came into TSX venture-listed companies. And I would estimate about 3/4 of that was in the mining companies in that sector, perhaps even more. So $15 billion of new money coming into junior resource companies. A lot of that was spent without generating any tangible results. Part of it went into investor relations, part of it into admin, directors' salaries, all the rest of it. A good part of it was spent on exploration, but unfortunately it's a high-risk business, and a large part of that money was spent on exploration that didn't generate results. The net result is we have $15 billion of new paper created, new share certificates during that 2-year period, without a lot to show for it. And the net result is that paper is being sold by investors that wish they had never gotten into these companies. It's put a huge down pressure on the junior markets. And I think we're going to see that downward pressure continue for a long time. Look, without putting specific numbers on it, probably the majority of companies in this space are still overvalued. And given that they're trading at 1 or 2 or 3 cents a share, you might think, well, how can they possibly be overvalued? Well, a company that has no money, no project, mediocre management, what is the fundamental value of that company? And we're going to see those valuations continue downward until they reach that fundamental value, which in many cases is zero. The good news is there are some outstanding bargains to be found in this market. As the bad companies were being sold off, the good companies were sold off along with the bad, and we're seeing irrationally low valuations on some really excellent companies. Companies that have cash, that have projects, that have management, are trading at very, very low prices. But more than ever, this is a market that depends on being extremely selective. And companies that have good projects, that have cash in the bank or that have access to cash, trading at very low prices, we're going to see 10 times returns coming out of this market over the next year or two, but on very selective companies.
Yeah, I find that very interesting, that the market still is very much saturated with too many companies out there, too many projects, money not focused on quality projects or advancing these projects that are takeover targets. In your article, you said that we should be looking for takeover companies, projects and companies that are to a stage where they know that there is gold or silver in that ground. They aren't just drilling holes looking in random areas for this. They have it proven, and they're in a good jurisdiction with good management, so then we can look for them to be taken over. We've seen recently companies taken over in the last couple months. Even when supposed to be a slow December, there were a couple takeovers, which I think is a sign that shows companies are out there looking, and there are good projects. You just need to, as you said, filter through them.
Well, that's very true. You know, three of the companies that we follow in the newsletter were taken over in the last couple of months of last year at takeover offers that were effectively double what they were trading at before the offers came through. So the mining industry is in the best financial position that it has ever been in. Metal prices are high. They're not perhaps as high as they were at the height, but they're still strong metal prices, generating big profits for the producing companies. They're sitting on massive amounts of cash right now, more than they've ever had in history, and they're looking to build their businesses. And remember, whether or not a company wants to expand, just to stay flat, they've got to continually build new mines because, you know, a mine has a finite life, they're depleted, and just to stay flat, the mining industry needs to constantly build new mines. So by focusing on these companies that have good, strong assets and are advancing those to the point where they can go into production, and for the most part, these juniors are going to be taken over by larger companies, and there's no better exit strategy than getting a check from a larger company to unload your shares at the end of the day. We're going to see a lot of that sort of activity happening over the next little while. There was a bit of a hiatus last year as the majors, along with all the other companies and investors around the world, were concerned about what's going to happen next. So they sort of stepped back from any sort of an aggressive takeover stance. We're seeing more clarity in Europe. We're seeing clarity in other parts of the world. We're getting back to business as normal, which means the majors are going to step up their takeover activities. The juniors that have good projects are going to be taken over in the course of this year, and we're going to see big profits by owning those companies.
Well, even I think last year some of the majors were concerned with the market, like you said, and what we did see was these stock prices continue to drop and drop. So the majors, even though they're paying a premium, are still getting it for cheaper than they would have 6 months ago. And a couple of the deals that you mentioned in your article were cash deals, which I find very significant because in a really hot market, you find a lot more stock deals, I find. But in this cash basis, these companies have money to spend, and they know how valuable this property is, and they're getting it for a huge discount when they bring it into production.
Well, that's right. Even if they're paying double what the market price was, they're still getting these things at a huge bargain. And another really important observation is that a lot of the takeover offers are coming from emerging market companies. You know, there was a Brazilian individual, privately owned company that made, $300 million takeover offer. And a Chinese company. Companies around the world, the mining companies in these emerging market jurisdictions, part of it is those companies have a much better perspective on the value of resources long term. You know, in the Western world, we're sitting here and we're whining and complaining and moaning about how bad the economy is, whereas in the growth markets, the attitude is, where will we find enough resources to continue to fuel the pace of growth that we're enjoying at this time?
They see that growth right around them, and they see that to build up their economy, they need these resources. We've kind of put those on the side. We look at iPads almost like resources now, and quite frankly, it's the stuff that goes into them to make them that we need to keep on developing. And as you said, we're not replacing the metal, the production that's coming off the market at the same pace that it's growing and it's coming off the market. So we're running into almost a supply shortage coming up here.
Well, the big hiatus we've seen in mine development over the last decade, really. Resources and reserves of most of the metals around the world have been declining during that period as the pace of finding new deposits has fallen way short of the amount of metal that was produced each year. So longer term, it's very supportive of strong metal prices going forward. Now, would I bet on a higher metal price? No, not necessarily, but certainly 100% certainty that the larger companies will buy smaller companies to get deposits to develop new mines.
Yeah, and with the low-grade deposits that need to be mined because these high-grade deposits aren't there anymore, we need at least the metal price that we're at right now for companies to continue to bring these into production, which they're going to need to do.
There's a chart that I'll be publishing in the upcoming newsletter that shows gold price forecasts over the last decade in relation to what actually happened in the gold price. I'm trying to get my hands on a similar one for the copper market. It's astounding how inaccurate the analyst forecasts have been for the metal prices going forward consistently over a decade-long period. And that's probably going to continue. The analysts in the West take this negative outlook on the metal prices, and in the emerging markets, they've got a much more realistic outlook on metals and prices and supply and demand, and they're going to continue to just buy up the metals around the world. And as investors, what do? We own these things, and if they want to make us a cash offer, well, we'll take it.
Yeah, we vote yes. Now, are there any companies that you're really closely following, looking up to in 2013?
Well, there's a number of very good companies, which, of course, we're following in the newsletter, and I'm just at this moment working on the next issue of the newsletter, and I'll be highlighting the companies that I'm most excited about at this point in time.
Okay. Well, thank you very much, Lawrence. I greatly appreciate talking to you. I hope everybody out there learned a lot from Lawrence. As I said, go out there, check out his website, sign up for his newsletter. Very informative. Lawrence gives you a great rundown on the companies he's following, and he's looking at it from an investing standpoint, which is what we all are. So thanks again, Lawrence, and we'll be back with you shortly.